The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Thursday, 29th of May. Welcome back, Jeremy. Good to have you on the show again.
Hi, Gareth. Good to be here.
It's been yet another exciting week. A few scary goings on at the macro level, a bit of excitement in the UK markets, a bit of positivity there. But where would you say we should start for our macro conversation this week?
Well, we began the week with the dollar continuing its downward move, and consequently the pound rose to touch $1.36, its highest level since early 2022. And UK 10-year gilt yields pushed up towards 4.8%. But things settled down, partly because in Japan, which, as we talked about before, has been the sort of focal point for some of these yippie bond markets, the finance ministry decided to send a questionnaire to its market participants regarding the appropriate issuance for their government bonds. But this had the desired effect of lowering super long duration Japanese government bonds. We know that Japan is seeking to regain some control over and some stability in its market after last week's very poor 20-year debt auction, which saw the weakest demand for more than a decade. In that regard, some of these explanations out there for why the bond market is doing what it's doing reminded me of some of those conversations that we used to have with the sales traders, when you wanted to know what a share price was doing. And the smart-ass sales trader answer was always, there's more buyers than sellers, or vice versa. So this seems to be how the financial pages report what's going on in bond markets. Bond prices were down, yields went up because of a weak bond auction.
So where do you think this gets Japan? How do you think it moves them forward?
Well, I think the only real explanation for why this sort of questionnaire actually helped stabilize things is sort of similar to the first step that any addict takes when they admit that they have a problem. Japan's Ministry of Finance basically, by sending round its questionnaire, admitted that it has a problem. It has an addiction to debt, which typically it has historically mainly bought itself through its central bank. But this addiction to debt helps its investors, who can borrow in yen, to finance all manner of other assets, which we've talked about before, essentially the carry trade. So the bullish interpretation of what happened is that, like any addict, Japan has taken one step along its several-step program of treatment for its addiction. But the fact that this was used as a reason not to sell JGBs or even to buy them, I think shows you how bad people thought this problem previously was. Anyway, it only actually lasted for 2 days, because yesterday we got news of another problematic Japanese bond auction, sparking a bit of a resurgence of this negative sentiment for bond markets, not just in Japan, but elsewhere. So maybe the questionnaire didn't actually elicit the answers that they were looking for.
Worry returns.
Yeah, and it's not like Japan only has this problem to worry about, because in its real economy, not only is Japan financed, as we've said before, like a leveraged hedge fund, it is still a manufacturing powerhouse, but it is an economy that's under assault from its neighbour in China, being eclipsed in terms of advanced manufacturing technology and critically price, and from the US in terms of the proposed tariff arrangements that the US wants to put on Japanese imports. This sort of turmoil, particularly in the automotive market, was heightened this week as BYD, who is the largest EV manufacturer, sort of asserts its pricing power. Its shares fell quite sharply in Hong Kong after it instituted a wave of price reductions on its product range of about a third. And meanwhile, no news on Japan-US trade negotiations. That still hasn't happened.
Still not
and
done.
I think Japan is hanging tough in these negotiations and pointing to the fact that it owns over $1 trillion worth of US Treasuries.
If that US Treasury market goes the wrong way, it would take more than a questionnaire to solve the problems that they might see.
Yeah.
And how's the States been faring while Japan's been going through these weak bond markets?
Well, Trump's tariffs have hit a judicial roadblock. Elon Musk has distanced himself from the political process and particularly from the fiscal irresponsibility, as he sees it, of the big, beautiful bill. Meanwhile, Trump is being accused by grateful investors who are profiting from the new buy the dip acronym, which they call the taco trade. I don't know if you've heard this one.
Trump always chickens out. Is that
That's right. Yeah, which has seemed to have summed up the way that canny investors can take advantage of the fact that every time any initiative is made regarding tariffs, they're almost immediately backtracked. So again, with this judicial roadblock, the uncertainty around tariffs is continuing.
Yeah, at least he can blame the judges rather than just himself chickening out or backing down.
But meanwhile, the sort of orange man bad media is loving this. Risk asset prices are recovering quite strongly this week. Equity markets are generally higher. The tariff beatings that these equities have been told to expect are being deferred and maybe now eliminated. We also got an earnings update from NVIDIA, where its CEO, Jensen Huang, criticized US technology sanctions against China, but also reconfirmed strong AI chip demand. So, yeah, good news for the Mag 7. But what's good for the equities is not necessarily good for bond markets. And tariff news leaves the vigilant bond investors with a bit of a problem, because they were hoping that at least some of these tariff revenues might partially plug the gap left by the big, beautiful bill. So on top of all this, today we got confirmation that the US GDP in Q1 this year has turned negative. So that's not helpful. But yeah, as Trump himself has called it, bond markets have remained yippy. And I think, as the FT reported, a Deutsche Bank bond specialist saying, there are basically only two solutions for this debt problem. Either the US has to sharply revise its fiscal policy, or the non-dollar value of US debt has to decline materially until it becomes cheap enough for foreign investors to return. So that means dollar down, US bond yields up for the foreseeable future. And I think making sure these adjustments take place in a controlled manner is priority number one for any policymaker, whether you're involved in fiscal policy or monetary policy or indeed trade policy.
Okay. How about the UK with all these other big things going on? How are we sailing through the macro world?
Well, yeah, as I'd call it, in other related deck chair moving news, the UK is shifting its funding ambitions to the shorter end of the yield curve, which basically means that in an attempt to lower its interest bill and meet Rachel Reeves' fiscal rules, we are basically going to not issue longer duration debt, but we're going to term it forward, as the US has been doing, to where it is a bit cheaper.
Yeah, so that's the governmental equivalent of paying your mortgage with your credit card, give or take, is that right?
Absolutely. And it's an intermediate step, as you rightly point out, towards directly funding the deficit by money printing. So it not only exposes the borrower to more interest rate risk, but also increases the risk of outright sort of EM-style currency debasement risk, and reduces the scope for the bank to lower its short-term rates. So it has consequences. And I think as far as the UK is concerned, things like house builders and building materials and things we've talked about before, and I think one of the fundamental pillars of the investment case for UK equities is that we're likely to get lower rates. So if that becomes problematic or doesn't happen, then there's something to keep an eye on for sure. Meanwhile, the IMF seems to have given some scope to allow Rachel Reeves to bend her previously unbendable fiscal rules. All she needs now is the permission from the frankly ludicrously named Office of Budget Responsibility in order to see more UK borrowing and consequently an easing of monetary conditions to accommodate it, which is, as you would probably rightly recognise, QE in all but name. but I think we're some way from that. But the sort of tectonic plates of how governments of the world fund themselves are having direct implications for markets.
So what's the takeaway from all this then? Where do we get to?
Well, globally, the long-term inflation risk, as expressed by rising term premia in all bond markets, is proving difficult for policymakers to put back in the bottle. Longer-term inflation expectations are out there, and particularly in the US, it has implications elsewhere, but in the US, they've given up on Doge, they've given up on fiscal restraint, and basically decided to pivot back to the reliable way of outrunning the debt problem. So they're going back to growth at the expense of controlling long-term inflation. And as I think we mentioned last week, this idea that 2% inflation is the target, well, that could become 2.5%, 3.5% as we move forward.
Which would be bad for most currencies, but good for gold and potentially Bitcoin, as we talked about.
Yes, and probably good for equities, particularly equities that have proven themselves to be resilient and adaptable. And as we've talked before, are characteristics of the UK equities that we follow most closely. So what have you seen in the UK this week?
Yeah, it's been another interesting week. A couple of progressive clients had news. Beeks and Watkin Jones. So Beeks, first of all, they're a cloud-based infrastructure provider into the exchange and trading markets. They announced, I think it was actually the back end of last week, a multi-year deal with the Australian ASX exchange, which is a decent contract for them. They were pretty clear that it really underpinned existing forecasts rather than being scoped for upgrade. So it was kind of built into the pre-existing expectations. But it's a strong reference site. It's a very nice client for them to have won. And I think just as importantly, this is one of Beeks' new revenue share deals where they've actually taken a bit of heat from investors on the move that they made towards a revenue share contract structure. But this is a new deal signed on that basis. And I think if they can start to sign a few more of these, that would potentially demonstrate the benefits of that transition that they're making. So hopefully we'll see more in the near future from Beeks. And then separately, we have an update from Watkin Jones, which is a developer of properties for the build-to-rent and student accommodation markets. They published H1 results through to the end of March. And it was a pretty strong, or at least in line, set of comments for them. They talked about greater levels of confidence around the pipeline and their ability to forward sell some of that pipeline across the balance of the year. So we introduced FY25 forecasts for the first time. So it's good to have estimates back in the market. I think that demonstrates that there's a bit of confidence coming back into Watkin Jones and that market more broadly, the UK building and construction sector. Yes, they are relying on interest rates hopefully coming down, but even in advance of that, there does seem to be an increasing level of positivity and confidence coming back into that sector. So yeah, good to see from those two. And then lastly, what about next week? What have we got to look forward to over the next 7 days or so?
Well, tomorrow we get some US PCE inflation data with the core PCE inflation measure, which is sort of widely relied upon in the Fed regarding their interest rate deliberations. This is likely to show a month-on-month uptick, so not great news. Next week is about US jobs, EA inflation and rates, and some US survey data. The euro area inflation print is likely to be downwards, which is more to do with the slower economy, I think, than any great policy success. In the US, the ISM services PMI and employment data, we've got the non-farm payroll release next Friday. They both offer scope for sort of further worries about this US slowdown, which we've seen confirmation of this week, turning into an outright recession. So we're going to get only, I think it is the second negative GDP print in 5 years for the US economy. If we get 2 in a row, it's a technical recession and definitely something the Trump administration would want to avoid. So not saying it's going to happen, and the equity market is definitely not expecting the US to go into recession right now, but watch this space. And we also next week get the rate decision from the ECB, and they're likely to reduce rates by a further 1/4 point to try and get things going in the euro area.
Great. Well, there'll be a lot to talk through and look forward to catching up with you this time next week to do exactly that. Talk to you then.
All right. Look forward to it.
Brought to you by Progressive Equity.